Most people think startup investing is luck. But let me ask you something. Why was Sequoia into all of the hottest deals? Instagram, Zoom, LinkedIn, Airbnb, Stripe, Snowflake. How come? It cannot be luck. The reality is they actually use a system. And if you're an investor who's looking to deploy capital into startups, or if you're a founder looking to understand what makes investors tick, this video is for you. I'll show you exactly the 5 steps that venture capitalists use to separate the winning startups from the losing ones and how you can use them whether you're an investor or a founder. But first, before we start, this is a new channel. Please consider subscribing. I'm publishing content on the VC industry, the startup world, and behind the scenes of Y Combinator. So please give me a subscription. Thank you in advance. Okay, let's break down the 5 steps that differentiate between world-class VCs and tourist investors. First one is deal sourcing. This is extremely important. So, how do VC find the next billion-dollar opportunities? The truth is, they don't come on your website or in your inbox. You gotta go out and chase them. For example, with Lobster Capital, my fund, I only invest in the top 2% of Y Combinator companies. Do you think a startup that's at YC, that's in the top 2%, is actually coming to my website to fill out a form? No way! I have to go out and chase them. So how does it work? Well, you gotta stay top of mind. They gotta know about you ahead of time. And you gotta build relationships with them when they're not raising. Because when they do fundraise, it's usually over in a matter of days, if not hours. So you gotta be top of mind, you gotta build relationships with them, and then you gotta bring more than just money. Money becomes irrelevant for such startups because they can raise from anyone. Everybody would be very, very happy to give them money. So the question becomes, what do you bring on top of money? I love this example of Cyan Banister, who shared in a podcast that she actually camped out in front of the founders of Niantic, in front of their door, to convince them to take their money because she could help them with much more than financially, actually help them build the product. And that persistence allowed her to invest and have an amazing outcome from this investment. Remember, if you really, really want the top deals, you're competing with the best of the best in Silicon Valley, the Andreessen Horowitz, the Sequoia of the world. So you have to be persistent, relentless, you have to be top of mind, and you have to have very, very strong relationships with those founders. That's how you win elite world-class deals. Step 2 is deal screening. Once you source the deal, you actually gotta see if it fits what you're looking to invest into. I made a more in-depth video about this topic that you can watch, but here I'll break down 4 things that you need to look for when you're screening a deal. Let's look at the market size, the problem urgency, the founder fit, and finally the early traction. Market size, well, you want a market big enough so that the company can grow a lot. You want the company to reach hundreds of millions of revenue, if not billions of dollars in revenue, in order to get a huge exit justifying your investment. Then, problem urgency. Is it a painkiller or is it a vitamin? Is it a nice to have or is it a must have? You want customers that are fighting to actually get the product out of the hands of your team, of your startup, of your founder, because it's going to be much easier to sell. And so you need to look at, are the customers really excited? Would they be really disappointed if the product went away? Problem urgency. And then founder fit. Is the team of the founders the right team to tackle this problem? Do they have a personal connection? Do they have an unfair advantage? Do they have something that makes them uniquely equipped to actually tackle that problem and solve it? Finally, of course, early traction. You want the company to already have sold to its customers so that it's more than just a promise. They're actually selling it. Customers are actually buying it and paying for it, and it translates into early traction for them. My bar, my minimum when I invest around demo day in YC startups is startups that already have between 500K and 2 million in ARR. And those are startups that are less than a year old, already doing between $500,000 and 2 million in annual recurring revenue. Again, if you want to learn more on this specific topic, you can go check out my previous video. For now, let's move on to the 3rd step. 3rd step is due diligence. Okay, it looks good, it fits your criteria, but you gotta check a bunch of stuff. What's the competitive market? You know, what are the financials of the company? What about the founders? What did they do before? Any red flags here? You want to know what's under the hood. What's the burn rate? What's the customer acquisition? What's the retention like? Sometimes flashy numbers of early traction can be deceitful because they could hide something. There's always a way to spin the numbers and omit something else that could be a potential problem or trouble in the future.
We just repackage it with a bunch of other shit that didn't sell and put it into a CDO. The whole thing is suddenly considered diversified. And then the whores at the rating agency give it a 92, 93% AAA rating. No questions asked.
You want the company to have a valuation that's in line with their traction. If you have, 10K MRR and you're raising at 50 million valuation, we have a problem. We want a company that can grow and increase its margin or keep its margin, and not a company that's gonna grow and they need to hire a ton of people to actually service the product. So there's a lot of moving parts, a lot of things that you gotta check. Once you're, seduced by the initial idea, check that everything checks out, everything is okay, and there are no problems, red flags, or anything that's gonna happen in the company. In this specific part, all of your experience as an investor, as a VC, will come in very handy, because all of the problems that you've seen potentially in previous startups, you can check here to make sure the history is not going to repeat itself. Step 4 is the investment decision. And this is a difficult part for most people because you have limited time, limited information, limited resources, and you got to come to a final decision. And you're always thinking, what if I say yes and invest and it goes to zero? What if I say no and don't invest and the company explodes and becomes very big? So you've got to separate all of your feelings, you've got to stay away from the FOMO, fear of missing out, and you've got to make an educated decision at a point in time where you have enough data points. You're never going to have the full picture or all of the data that you want, but you have to reach a point where you have enough data to make a decision. Ultimately, what I like to look for is a field of small clues and just add them up. If there's one small thing that doesn't really feel right, and then another one, and the startup looks great, but there's a few things where you're thinking, then for me, they add up, and I'm like, okay, that's not a good thing. That's not a good deal, and I pass. On the other side, sometimes you have a first good sign, and a second one, and a third one, and the founder have a great, they make a great impression on you, and then you talk to someone else, and they love what they're building as well, and you read something great online, and etc. Those small things add up as well, and this helps me have a global overall feeling about the startup, again, provided that everything else checks out before. So deciding is a very lonely and difficult process, but it is extremely important to be able to make decisions and to make decisions fast, because again, if you want to invest in the top elite startups of the world, those rounds move very, very quickly. You need to be able to get back to them very quickly, otherwise you're going to miss the deal. The last thing you got to ask yourself is, can this company return my entire fund, my entire portfolio? Even if you're not a fund but an angel, every single investment has to have the potential to return everything, because most of the times you're going to lose even if you're good. And so every single investment must have the potential to return everything to justify that you make this investment. So this is also something that's supposed to help you decide whether or not you want to actually invest. Step number 5 is post-investment management. Many people think after you've invested, you're done, that's it. If you want to play in the big league, if you want to attract elite and top world-class startups, you've got to do much, much more than just providing money. You've got to help after the money is wired. You've got to help with hiring, with go-to-market, with whatever the entrepreneur is needing. You got to be there for him, for her, for them, and just help them navigate the startup world. Being an entrepreneur is very lonely and very difficult, and that's where being an entrepreneur in the past, for myself, for example, really helps, because I know exactly what they're going through, what they need help with. And so, I've introduced other investors to some of my founders, and sometimes I remember out of 5 introductions, 3 investors came in, and that led to almost $1 million of fresh capital in 5 emails. Other times, a founder was struggling with B2B acquisition, and I helped that founder with running webinars to actually acquire customers, which led them to getting 90% of their new customers from webinars, and then raising a round from Sequoia thanks to how fast they were growing. So you've got to actually put yourself out there, be with the founders. This is what's going to build your reputation. I believe this is parts of what has built mine, and how I'm able now to really invest in top deals is really not stopping at the money, but helping as much as you can. And if any of my founders is watching this, most likely that I'm always here to help. But if you're watching this and you want my help, even if you're not one of my investment, actually, feel free to reach out and I'll do my best to try to help you. Okay, now let's put this into action. Let's look at real life example of my own portfolio and my own money where I used this 5-step process. I backed a YC startup in 2021 that was raising a seed round at 40 million valuation, which 2021, the valuations were high, but still at the time, a lot of people told me, I'm not investing in this round, 40 million is just too high compared to where the startup is. Actually, the startup was already doing several millions in ARR, so the valuation multiple, in my opinion, was not too high. What's interesting is today, they're doing over $100 million of annual run rate revenue. And so they're probably valued between 1 and 2 billion if you look at the multiple on the revenue that they make. And so that's at least a 35, 40x on my investment, and they've never raised again. So zero dilution, they just raised this big seed round because they've been profitable all the way. They never had to raise since then. Now on to more negative examples. So I saw a startup raising at YC Demo Day with 30K in MRR and $100 million valuation. That's, too disconnected, way too rich for me, so I passed. Another startup I wanted to invest into, I loved it, but then I asked for one single document to do my due diligence and the founder ghosted me. Big red flag. What doesn't he want me to see? And the company is actually doing really great today, and I know a lot of investors who invested in that startup, but I'm waiting for the other shoe to drop. Why did the founder behave like this? I don't know. Lastly, an AI startup was growing very quickly. I was very impressed with the founder, but I thought they had no defensibility. So I ended up passing as well. If your company is great and growing today, but there's no way to defend your idea and you're going to get copied and probably crushed and killed in a few months, that's, in my opinion, a very bad investment. Here's the bottom line. The best founders don't build products. They build traction, defensibility, and speed. That's what I invest into. If you're ready to learn how to win at YC Demo Day and get into the hottest YC deals, please subscribe because this is my next video where I'll take you behind the curtains and show you how to get into some of the hottest deals at YC Demo Day. Thank you for watching. I'll see you in the next one.